Imagine standing at the edge of a canyon, watching a massive convoy of trucks dumping concrete, steel, and high-tech servers into a construction site that stretches all the way to the horizon. It is loud, dusty, and happening at an unprecedented scale. We aren't talking about building roads or bridges here. We are talking about the physical backbone of artificial intelligence. Maya, when you look at the sheer amount of money flowing into this build-out, what is the first number that comes to your mind?
It is a number that makes your eyes glaze over at first, because it is almost too big to wrap your head around. We are looking at a projected capital expenditure of roughly $650 billion or more a year just to build the data centers, buy the chips, and lay down the power lines for AI. $650 billion. To put that in perspective, that is almost double what was spent in 2025, which was already a historic high of around $400 billion. It's like we've decided to build a transcontinental railroad, but instead of taking decades, we are trying to lay down all the tracks in a single weekend.
And that brings us to the one massive, overriding question that this entire series hangs on. Will all of this pay off? Or are we looking at the biggest overinvestment bubble in modern business history?
Exactly.
One small thing up front. We genuinely love these companies as stories, but we're explaining them, not recommending them.
So treat all of this as food for your own thinking, not financial advice. Stay curious, stay a little skeptical, and make your own calls.
Welcome to Episode 1 of Follow the AI Money, an educational series by the Working Thesis. I'm Theo.
And I'm Maya. We are so glad to have you here. Before we dive into the deep end of the financial pool, let's establish some quick ground rules. This channel is all about education. We are here to explore a way of thinking, a specific mental model we call the bottleneck lens. Our goal is to look at where the hard-to-expand, scarce inputs are in any major economic shift.
Right. And to do that, we will be using various public companies like Microsoft, Alphabet, Amazon, Meta, Oracle, and NVIDIA as real-world examples. But please remember, these are just illustrative examples to help us test our lens. Nothing we discuss here is a buy, sell, or hold recommendation. We don't have price targets, we aren't telling you what to do with your money, and we don't hold any positions in these names. This is purely about learning how to analyze the capital cycles.
It's about training our eyes to see the structural bottlenecks. And this first episode, Does the Money Hold Up?, is really the spine of our entire investigation. You see, the bottleneck lens is based on a simple premise. If you own the scarce, irreplaceable input that everyone needs, you can capture incredible profits. But there is a huge catch. A bottleneck is only valuable if the customers downstream have the money to keep buying it.
Exactly. Maya, let's talk about what this Capex wave looks like for 2026.
Well, we are looking at an aggregate hyperscaler capex of around $650 billion to $725 billion in 2026. Amazon is leading the charge, projected to spend an astonishing $200 billion. Microsoft is estimated to be spending between $120 and $190 billion. Alphabet is coming in around $175 to $185 billion. And Meta is looking at $115 to $135 billion. When you add Oracle and the others to that mix, the total is just astronomical.
But in 2026, their capital intensity has shot up to utility-like levels. We are talking about AWS at roughly 57% of its revenue, Meta at 52%, Microsoft at 48%, and Google Cloud or Alphabet at 45%.
To fund this, the Big Five issued an incredible $108 billion of new debt in 2025 alone, and some analysts forecast up to $1.5 trillion of cumulative debt issuance ahead. Look at Alphabet. Their long-term debt literally quadrupled in 2025, jumping from about $12.5 billion to over $46.5 billion.
Amazon, which has historically been a free cash flow machine, is actually projected by major banks to slide into negative free cash flow territory for 2026. Morgan Stanley is estimating negative $17 billion, and Bank of America has it as low as negative $28 billion. In fact, if you look at the combined free cash flow of the Big Four, It dropped from about $237 billion in 2024 to around $200 billion in 2025, and the downward slope is projected to get even steeper. Let's look at the bull case first. If you talk to the executives running these hyperscalers or the investors who are highly optimistic about this cycle, their main argument is remarkably simple. This market is supply constrained, not demand constrained. They are saying, we aren't overbuilding because we want to. We are building because we literally cannot keep up with our customers' hunger for compute.
Yes, and they have some very heavy-duty numbers to back that up. Take Microsoft, for instance. They are pointing to an unfilled Azure backlog of roughly $80 billion. That is $80 billion of contracted business waiting for physical infrastructure to be built so it can be delivered. And Google Cloud is even more eye-popping. Their contracted backlog, what accountants call remaining performance obligations or RPO, is sitting at over $460 billion.
OpenAI's annual recurring revenue, or ARR, is reportedly around $20 billion, which has roughly tripled in just a single year. Anthropic has grown its ARR to about $9 billion, up from just $1 billion at the end of 2024, a ninefold increase. And Microsoft's own AI run rate is sitting at approximately $37 billion, which is up 123% year over year.
And then there is the existential argument, which is perhaps the most powerful driver of this spending.
Absolutely.
Right, and that is exactly the point NVIDIA's Jensen Huang makes when people compare this to the dot-com bubble.
Okay, so that is a very compelling bull case. But let's cross the aisle and look at the bear case, because the skeptics are armed with some incredibly sober macro math. Let's start with what is widely known as the revenue gap, which is the core pillar of the bearish argument. Maya, how do the bears look at this math?
The bears look at this through a cold, structural lens, and the most prominent analysis comes from institutions like Bain and Company in their Global Technology Report. Bain points out that to justify and fund the astronomical compute infrastructure being built, the tech industry needs to generate roughly $2 trillion in brand new, incremental annual AI revenue by the year 2030. But when you look at the current trajectory of actual AI product revenue, we are tracking toward a massive annual shortfall of about $800 billion.
$800 billion is a massive gap. It's not a rounding error. It's a structural chasm. And that echoes Sequoia's famous $600 billion question, which pointed out that there is a fundamental mismatch between the capital being plowed into GPUs and the actual end-user revenue being generated to pay for them.
To reach that 2030 scale, we're talking about adding roughly 200 gigawatts of incremental AI compute demand to the power grid. An MIT study recently analyzed generative AI adoption and found that roughly 95% of enterprise pilots have shown no measurable return on investment yet.
95%? This leads us directly to the second major bear argument, which shifts the spotlight from the software market to the corporate ledger. This is the earnings quality and depreciation debate, and it's a point that well-known investor Michael Burry has been shouting from the rooftops. Maya, help us understand the accounting trick that the bears are flagging here.
This is a classic accounting issue, but on a massive scale. When a company buys an asset, like a GPU, they don't expense the entire cost immediately. Instead, they spread that cost over the useful life of the asset through depreciation.
But what Burry and other critics have pointed out is that the hyperscalers have recently stretched the estimated useful life of these GPUs on their books from those realistic 2 to 3 years out to 5 or even 6 years.
Burry's calculations suggest that this change understates total depreciation by an eye-watering $176 billion between 2026 and 2028.
In fact, Burry's estimates show that by 2028, Oracle's profits could be overstated by about 27% and Meta's by roughly 21%, solely due to this accounting stretch. Jim Chanos has pointed out a similar concern, calling it a Capex treadmill. He argues that these companies have to keep spending higher and higher amounts just to replace depreciating assets, but their book values make it look like they are accumulating durable wealth.
Now, to be absolutely fair, we have to look at the industry's pushback on this.
Now we have to talk about something a bit more complex, but absolutely central to the bear thesis: circular financing. This is a topic that has generated a lot of quiet whispering on Wall Street. and we want to describe it as neutrally and clearly as possible. Maya, what is the structure of these circular transactions, and why are critics so worried about them?
At its simplest, circular financing refers to a setup where capital flows in a loop between a technology provider and its customers, making the underlying demand look much stronger and more organic than it actually is. Let's look at the public examples. Critics often point to deals like NVIDIA's reported $100 billion commitment to OpenAI, or the massive joint projects like the Oracle-OpenAI collaboration, often referred to as the Stargate Data Center Initiative. Another common example is the use of vendor financing in the cloud space, particularly with specialized GPU cloud providers like CoreWeave.
Right, so let's walk through how a skeptic views this loop. Imagine Company A is a massive chip designer. They invest a large sum of capital into Company B, which is an AI model developer. Or they provide vendor financing to Company C, which is a specialized cloud startup. Company B or C then takes that capital and uses it to rent server capacity from a hyperscaler, who in turn uses that money to buy chips from Company A.
Exactly.
Now, the industry pushback on this is very clear and shouldn't be ignored. It's impossible to have this conversation without addressing the elephant in the room. Is this just the year 2000 all over again?
In 2000, you had companies with literally no revenue, no profits, and nothing but a dot-com name change trading at astronomical valuations.
Yes, and overall market multiples are significantly lower than they were at the peak of the 2000 bubble. Plus, we aren't seeing the same flood of highly speculative, unprofitable initial public offerings. But at the same time, we can't ignore the fact that the capital concentration and the debt issuance are genuinely bubble adjacent. Look at Morgan Stanley's research. They are forecasting about $2.9 trillion in global data center construction by 2028.
JP Morgan's Jamie Dimon has stated he is far more worried than others, pointing to a very real correction risk within the next 6 to 24 months.
And Goldman Sachs has done some fascinating modeling on this. They warned that if hyperscaler Capex simply reverts back toward its 2022 levels, about 30% of the projected revenue growth for the entire S&P 500 could completely evaporate. Goldman CEO David Solomon expects a drawdown within a couple of years. Even OpenAI's Sam Altman has conceded that the current environment has a bit of a bubble feel to it. So, the honest middle ground is that while the underlying technology and revenue are vastly superior to 2000, the capital risk and the leverage in the system are very real. So, we have these two massive, compelling arguments locked in a generational tug-of-war. How do we, as outside observers, actually monitor this? We don't want to just guess or take a side. We want to watch the tape. What are the key operational tells that will decide who is right?
We've mapped out 5 key tells that we think will give us the answer over the next year or two. The first is backlog conversion. We need to watch that massive $460 billion contracted backlog at Google Cloud and the $80 billion at Microsoft. Does that paper backlog actually convert into recognized recurring quarterly revenue, or do those contracts get delayed, renegotiated, or canceled?
The second tell is what we call the supply catch-up test. Right now, everything is sold out, which makes it easy to claim demand is infinite. But as these hundreds of billions of dollars of new data centers actually open their doors and supply catches up with demand, what happens? If the new capacity is immediately snapped up, the bulls are right.
The third tell is the Bain and Sequoia revenue gap.
If we see depreciation expenses starting to climb rapidly, that will be Michael Burry's thesis playing out in real time.
If Amazon's free cash flow goes deeply negative, and if Alphabet and Microsoft have to continue issuing tens of billions of dollars of new debt to fund their data centers, investor patience will wear thin. The 2026 and 2027 earnings seasons will be the ultimate jury.
This brings us back to our core framework, the bottleneck lens. How does this entire Capex durability debate feed into how we actually think about investing and technology cycles?
This is where the bottleneck lens becomes incredibly practical. You see, this Capex debate represents the absolute valuation ceiling for the entire technology ecosystem. A supplier, whether they make chips, cooling systems, or copper cables, is only as secure as their customers' ability and willingness to keep paying them. If the hyperscalers are forced to pull back on spending, the supplier's revenue will dry up, no matter how scarce their physical product is.
But this is also where we use what we call the duration ladder. If a capital reset happens, not all inputs are affected equally. The highly cyclical, high beta layers, like the compute and memory silicon, will feel the pain almost instantly. Why? Because chips can be manufactured relatively quickly, and a sudden drop in demand leads to immediate oversupply and price crashes.
But if you look at the other end of the duration ladder, at the physical infrastructure inputs, like power grids, electrical transmission equipment, copper mining, and uranium supply, those are incredibly hard to expand and take years, sometimes a decade, to bring online. Even if AI Capex cools down temporarily, the structural deficit in global electrical grids and clean energy remains.
Exactly. Those physical infrastructure bottlenecks are far more insulated because they serve a broader, multi-decade structural trend that extends beyond just the immediate AI training rush. So, our lens isn't about being blindly bullish or bearish on AI. That brings us to the end of our first episode. We've laid out the financial spine of this entire technological wave. And as you can see, the tension between the record-shattering backlogs of the bulls and the structural revenue gaps of the bears is one of the most exciting financial dramas of our lifetime.
It really is. And the key takeaway for us is to keep our eyes on the cold, hard numbers. Don't get swept up in the daily market noise or the sensational headlines. Watch the earnings seasons, track the free cash flows, and look for those operational tells we discussed.
In our next episode, we are going to dive straight into one of the most fascinating physical bottlenecks in the entire compute layer, the memory wall. We'll be talking about high bandwidth memory, or HBM, why it is so incredibly difficult to manufacture, and why it has become one of the ultimate scarce inputs in the modern world.
It is going to be a fascinating deep dive, and we can't wait to share it with you. Thank you so much for joining us today on Follow the AI Money.
We'll see you in episode 2.
That's a wrap for today. Thanks for thinking it through with us. We're just testing our theses out loud, one day at a time.
Catch you on the next one. Stay curious and tell us where we're wrong.